What can you claim on tax depreciation for your Airbnb property? Hey everyone, Tuan Duong, founder of Durotax Quantity Surveys here for another video designed to help you become a better property investor. Airbnb has been widely popular, giving property investors another investment strategy. But with new technology comes confusion around things like tax depreciation. And the sad truth is that most people are getting caught off guard with what they can and can't claim when it comes to tax depreciation for something like an Airbnb property. So if you're watching this video, then you either already have an Airbnb property or you're considering using your investment property as one. So let's clear up once and for all what you can claim on tax depreciation for your Airbnb property. But before we get into the nitty-gritty, I want to point out that this video is intended for general guidance and shouldn't be used for tax or financial advice. We always recommend you engage in a qualified accountant to assess your individual situation. Now, there are usually two scenarios that can affect your Airbnb tax deduction situation. Scenario 1, if you rent out your entire home for Airbnb, and scenario 2, if you rent out a portion of your home for Airbnb. To add to the confusion, these two scenarios are split into three different categories when it comes to tax deductions. Number 1, expenses and tax depreciation directly associated with the rented area. For example, renting out the bedroom. This can be tax deductible in full. Number 2, expenses and depreciation for shared areas. These need to be a portion, which means you need to calculate the percentage of the shared area being used by the guests. Number 3, expenses related to the private area only for the host. These aren't tax deductible at all. Beyond this, we need to also understand that there are some legislation and definitions around what type of accommodation Airbnb falls under. There are two types that people often get confused by. Type 1, short stay accommodation like hotels, motels, and guest houses. Type 2, residential properties, which are your regular rental properties, which Airbnb also falls under. What does this mean when it comes to claiming tax depreciation? Short stay accommodation generally has a significant advantage in claiming a higher rate of depreciation of 4% as long as the property was constructed after the 27th of February 1992. So for Airbnb instead, we would treat it just like a rental property with all the rules and regulations of a regular investment property. Now, let's talk about the two scenarios. Scenario 1, renting out your entire home. If you don't live in the property and the entire property is used for the purpose of Airbnb rentals, you can claim depreciation and other tax deductions on the entire premises, even if no one is occupying the property. But be careful, you can do this as long as the property is available at market rate. What does that mean? It means that you can't offer discounted mates rates to family and friends just to take advantage of tax deductions and depreciation. Also, if you move back into the property, you can't claim depreciation on any of the property from the date that you move back in. Instead, you'll need to calculate the deductions pro rata for the period that the property was used as a rental property. Scenario 2, renting out a portion of your home. In this scenario, you need to calculate the part of your home that you rent out, known as apportioning. This is something that a lot of Airbnb owners aren't aware of. The way this is calculated is based on the floor area that's used for private and rental purposes. What's also tricky is that since the 2017 legislative changes, what's called plant and equipment assets, like your air conditioners and ovens, aren't claimable unless it's brand new and your home isn't owner occupied, meaning you don't live in the home. So now that we have those two scenarios out of the way, what can you claim as a tax deduction for your Airbnb? For plant and equipment, which is called Division 40, you can claim things like your couch, tables, chairs, beds, and even appliances. To find out more about the difference between Division 40 and 43, which are capital works, check out our video that explains all of this. For shared spaces, such as bathrooms and living rooms, they'd only be partly deductible because you'll need to apportion this too. Beyond that, capital works, which is Division 43, can also be claimed for depreciation, and again, you'll need to apportion this based on the calculations. Other tax deductions you can claim, depending on whether you rent out the entire property or a portion of it, include cleaning costs for the rented spaces, repairs and maintenance, food and meal provisions for Airbnb guests, Airbnb service fees and commission, as well as listing and property management costs. Other things such as interest on your loan, council rates, utilities and insurance costs can also be fully or partially claimed depending on which of the two scenarios you fall in. So the other tax you need to be careful of is capital gains tax. If you rent out some of your rooms on Airbnb for your principal place of residence, the ATO has indicated that you won't be completely exempt from the main residence capital gains tax scheme. If you're using a portion of your property to produce rental income, that means a portion of your property would also be liable to pay capital gains tax. This is a matter that's outside the scope of this video, but we recommend you engage an experienced accountant who can help with keeping accurate records and calculations so that you can properly figure out the apportioned floor space that's producing assessable rental income. Finally, make sure you observe any state government laws in relation to short-term rentals like Airbnb. For example, in New South Wales, Airbnbs are limited to 180 booked nights a year. This means if you've exhausted 180 days within the year, you need to make a decision on whether you transition to long-term leases or even move into the property yourself. Each choice has its own tax implications. So there you have it. Every investor's situation is different, with some more complex than others. Before you consider using your property for Airbnb, we recommend you take the following steps. Step 1. Get advice from a qualified accountant who can understand your tax situation before recommending whether you should consider Airbnb. Step 2. Obtain a valuation on your property so that you can consider whether there's a considerable CGT expense if you decide to rent it out on Airbnb. Step 3. If you're happy to do Airbnb, then you'll need to keep records of all your Airbnb activity and disclose the income in your tax return, and make sure you claim on all eligible Airbnb tax deductions. Step 4. Before you lodge your tax return, engage a quantity surveyor like us at DuoTax to provide you with a tax depreciation schedule so that you can maximize depreciation claims on Division 40 and 43. Besides interest paid on the loan, the tax depreciation is the second highest tax deduction claim you can make on your property. If you're interested in getting a free estimate on how much you can potentially claim, get in touch with our team. If you know a friend, colleague or family member that needs to hear this, please make sure you share this video with them. If you got a lot of value out of this video, check out our YouTube channel to subscribe for more. And make sure you click on the bell icon so that you get notified of the next video. I'm Tuan Duong. I'll see you next time.